What's up, everybody? Eric here. I'm back yet again with Euan Sinclair, and we're going to talk a little bit about the markets. We're going to talk about a course that he's launching up coming pretty soon here. But before we start diving into all of that, Euan, welcome back yet again. I convinced you / tricked you to come on again, I suppose, but it's awesome to have you on. Thank you for joining us.
Yeah, thanks. It's great for me. It's probably not as good for you. You really should have more friends, I guess.
Yeah, well, the problem is as soon as I start talking to people about options, their eyes promptly roll to the back of their head and then they fall asleep. So it is a small cohort of people who find any interest in these products. So yeah, I'm fortunate that you are one of those people. But with all that, before we get into the stuff on the course, I do want to talk just a little bit about the broader markets as per usual, because I think there's a lot of really interesting things going on. And I know that you have a different view on a lot of those things. So one of the things I want to talk about specifically is SVB, obviously, just a really interesting case. And at least for me, this is the second time I've seen this kind of scenario. The first time was back in 2008, and that was like my second year trading. So I had a very different eye on it. I wasn't trading around those events in 2008 too much, whereas what's been going on in SVB, at least as far as I've been able to decipher, I've been trading a lot around it. So I'm curious from a just structural standpoint, what do you think of the bank failure? What jumps to your mind?
I think it's okay. First of all, I don't think any of us should be thinking about this shit because we don't know enough about it to make informed decisions that are better than the market. We just don't. Because if you think about it, it's going to be like, well, sooner or later, we'll find out what really happened. So we're already, if you're honest with yourself, you don't know really what happened. You're waiting for someone, Michael Lewis or whoever, to write the book, and it's really dangerous to look at stuff from the outside. I mean, seriously, what do we know? We've read the newspaper. I haven't even done that, right? But also, I think it's dangerous to take major singular events and say, this is like 2008. I mean, it has some commonality with 2008, but it's not the same thing. This is a regional retail bank as opposed to an international investment bank. It's a different beast. Also, Dodd-Frank is in place now. I know they weakened it because this clown in charge of SVB was part of the lobbying group who tried to get it weakened. Good job there. But regulations are there for a reason. And after 2008, back when there was some sort of bipartisan consensus where we could get something done, people actually looked into what the problems were and addressed some of them. So I don't think we're going to see the same contagion. And I'm only saying that not because I know anything,
sure, just
because of the regulations in place. It doesn't seem like that is going to be the same sort of situation. And we're also, this isn't driven by sort of a collapse in a retail market and exacerbated by a whole bunch of, credit derivative swap derivatives.
Right.
It's really a very old-fashioned issue as far as I can tell. It's a run on a bank.
Right.
So yeah, that's sort of what I think. I think it's always dangerous to attach too much significance to how this is similar to a previous event.
Sure.
Which is one of the real problems with being long vol. Being long vol, everything's different all the time because you're never going to fight the same war twice. So are there commonalities? Sure. But I think we have to be cautious about what we really know. And even from a statistics standpoint, right? Even if this is exactly the same as 2008, what's your sample size? 1. Right. So good luck drawing inferences from that. The markets are hard enough to draw inferences from when you've got hundreds of data points. So having said that, I did take money out of bank accounts if it was above the FDIC limit and stuck them into safer places like bookmaker.eu and BetOnline and DraftKings. And I think for the short term, they legitimately had less risk than a bank. So that was the only thing I did as any result of this stuff.
Oh, that's interesting. So you didn't trade any of the you didn't trade anything in, well, you can't really trade SIVB, but anything in like XLF, the financials, anything like that?
Not because of this.
Got it.
I mean, I almost certainly did trade some of that stuff, or certainly stuff that had financial links, but it was only based on what those stocks did. I don't want to use say technically, but yeah, you know, how they moved around and what their volatility was, what the implied vol was. It wasn't based on like any particular view I had.
Got it. But couldn't the argument be made that a lot of those things made those moves because of what happened?
Oh, sure.
Yeah. Okay.
But I don't need to know the cause to know the thing
Right.
I'm looking at. So, yeah, I don't know. I could come up with some tortured analogy, but I really just care what happened rather than why it happened.
Got it.
And to be honest, I'm almost always long the financials anyway. They typically trade very cheap in terms of the vol premium. I'm talking about the big financials like, you know, JP Morgan, American Express, that kind of stuff. It's almost always a core at my longs.
This leads me to a follow-on question, because I've noticed this kind of course in our previous dialogues. Part of the way that I think about the markets, I have it like split into two pieces. There's like the tradable stuff, and then there's stuff that I just find interesting. And it sounds like you really weight the tradable practical side of things. Is there like a general interest that you have in like what happens in the market or what happens in the economy? And if so, like, what does that look like for you?
I don't care about it.
Yeah, I figured.
Like, I mean, it's not that I don't care about it so much as I find it ridiculously uninteresting. Like, I've literally never read the Wall Street Journal or the Financial Times. I couldn't care less. I mean, I'm much more interested in the sort of stats-based stuff, the gambling-based stuff.
Yeah.
You know, I come at it from that point of view. I mean, to me, this is no different from putting bets on women's cricket. You know, it's, although actually it is a little bit different because I quite like watching women's cricket as opposed to business. I hate it when people find out that I'm a trader and then they start talking to me about like business stuff. I'm like, seriously, I would much rather talk about how the Bears are going to screw up the draft or the Cubs or anything. Like, you know, we'll talk about Greek history, anything. But I think it's about the most boring thing on earth.
Yeah, I agree with that, especially if you're talking about like analyzing financials or like looking at a CEO's statements. I think the part that I find interesting is when you have like incredibly complex systems and the relationships between things. I just find that interesting. It's the same reason why I personally I'm fascinated by space. And it's because of this giant complex system and the relationship between things. But I actually really respect the way that you view the markets also, because I do think for a lot of people, they start diving into, you know, causation, causality, and then they're trying to essentially make really simple summations of extremely complex systems and turning that into a tradable event, which I think that kind of sets people up for failure more often than not. But
also, they've got to be better at that than the market.
Right.
I mean, and there's plenty of evidence, like being a domain specific expert isn't usually enough to make money in the market.
I see.
To the point where I know people who are on the board of biotech companies and they can't make money trading biotech companies.
Right.
So you don't know more than these people. And what they know is baked into the market. It's not, I don't know, it's people are going about, this is one of the things is very much in my philosophy, is you've got to pick an angle that's beatable. You know, you don't do the hardest thing just for the sake of it. And it's even with sports betting, right? I know a couple of professional sports gamblers. It's not about whether they think the Bears are a good team. Right. It's none of that. It's the total is this. The Bears point spread is this. So what should the point spread be in the first quarter? That's the sort of thing they're doing. It's not about, it's got nothing to do with football. It's all about relative prices between all these other things. And I think a lot of people tend to miss that. They get into sports gambling because they like sports, which is fine, but that's not going to make you money.
That actually leads me to a follow-on question is you were, explaining some of your interest in sports. Obviously, you like sports. What, why do you trade the markets then as compared to sports? Is it scale? Is it accessibility? Like what leads you to that versus trading or gambling around things that you find more interesting?
Um, when I first started, there was no sports gambling in the
Mm,
countries I lived in. Um, there wasn't in the US outside Vegas either, unless, there was no market, you'd say. And I got a job in the financial markets, basically. That's how I started there.
right.
Um, I still do sports, but not to the extent I have done in the past. It takes a lot of work. Like, it's a huge amount of work. And I think it's harder than trading.
That was my follow-on question. Why is that?
Trading, there are a lot of pretty clear risk premia that you can jump on.
Right.
Like, stocks go up. There you go. You've got a tide. You've got 8% a year to play with. Options are too expensive. So there you go. That gives you a head start. And also the transaction costs in trading are minimal compared to gambling. Like, I was just doing some golf gambling a while ago, and it's the markets are like, 115 on each side. That's a huge spread. If that was a financial market, it would be like 101 on each side. The spread in the spiders, for example, is by, practically speaking, zero. And makes a big difference.
Right. Yeah, that makes sense. And part of the reason why I ask is, I mean, I don't bet on sports at all. I don't really watch sports. I like to play them, but I do find it really interesting because I like martial arts, and I don't know if you bet on any of that stuff, but I mean, they're coming up with insane bets, like whether or not these dudes will touch gloves, whether or not they'll sit down in between. Like, it's that I find just so cool that they find all of these different things to bet on. But does that lead to more or less opportunity in sports betting? Because then to me, it also means that there would be decreased liquidity because there's so many different things people can bet on that it's difficult to like make a better market. Or again, I don't know how any of it works, but I find it interesting.
Um, a lot of those kind of bets are just complete sucker bets.
Yeah.
Like, literally, you can bet on the coin toss at the Super Bowl, which is like absolutely insane, particularly because, it's a 50-50 bet, but the odds they're paying you are terrible. If you just want a 50-50 bet, go and play roulette.
Right.
The odds there are a lot better. So I don't know, I can't remember the question there. Most of that stuff's just complete garbage, and a pro's not going to touch that. Prop bets on, like, will this player run for more than this many yards? That's a lot of pros' bread and butter, because those lines can be really soft, because the bookies put up hundreds of them. And it's like being a market maker in a way. It's like, as a customer, if you're a smart customer, you look at the market maker's lines and you're like, good price, good price, good price, good price, good price. Oh, you fucked that one up? Done. And that's exactly the same as sports betting, the bookies as well. They can't get everything right. But the problem is, as a gambler, you've got to go through 300 lines. Probably you've got 20 minutes to do it before the market changes and it gets knocked into line. So that's not the sort of thing you can just do by, typing some numbers into a spreadsheet for every single thing. It's a lot of data processing, a lot of work.
Right. That makes sense. So then to bring us back now towards the financial markets, we talked a little bit about SVB. I'm wondering from, again, not to suggest causality or anything like that, but from your experience, when there are these kind of events, do we have any data sets around the performance of volatility post the event? As in, it tends to remain in this kind of range for this number of days. That's part of the thing I was looking to discuss a little bit earlier is I have a lack of reference points. So I'm really curious if you create any of your own based on your experience of the studies that you've done on, again, understanding that the events are different, but sometimes they can have a similar catalyst.
Um, Yeah, that would be an interesting study. Again, I don't think you're going to find enough data points to come up with something that's rock solid, but it would
Yeah.
still be an interesting thing to look at. I haven't done it, but I think that is a legitimate actual study as opposed to sort of say, guessing about stuff. So yeah, you look and see, during 2008, look at all the financials that survived. What was the relaxation time for their vols, that kind of thing. That would be interesting to look at. Haven't done it, but would be.
Okay. Yeah, because I actually started just trying to compile some of it myself, but I don't have good enough data to like get a fair output. That's why I was curious if you looked at it, because I know your stuff's obviously way more advanced than mine.
I'm not sure it might just be the same as any other shock. Because like a Garch model is basically a vol model that has relaxation built into it. And for a given stock, the relaxation times are relatively constant no matter what the shock was driven by. I don't know that, but in this case, but I do know that there's a general phenomenon. That's why Garch models work so well, is because they are relatively stable like that.
Interesting. I had not thought about that. That's interesting. So another thing I wanted to talk to you about, again, this is, I know slightly outside of your preferred topics, but I am curious about your input nonetheless. I do find following the Fed's thought process interesting. Again, this isn't to forecast what the Fed's going to do. This isn't to forecast what the market's going to do in reaction to the Fed. It's literally just the function of the Fed I find curious. And I've been really surprised with the way that they've kind of jumped around based on these data points, that we got from the bank failure, then from some of the numbers that came out today. Does this, again, if you follow this stuff for any duration of time, is this like what you would expect from the Fed decision cycle? Again, just as like a acting institution, I'm curious. Because I mean, first we were essentially pricing in no chance, of 25 or no chance of essentially stay. And then that's essentially completely reverted over the course of a day. So I'm curious, if you've had experience with those kind of moves before, and just, a little detail around that.
No. I mean, I couldn't tell you how many Fed governors there are. I find the Fed very interesting, though, because people get very angry about it. And it becomes one of those things where people want the world to be a certain way.
Yes, and simple.
The character in The Wire, I can't remember who it was, who said to one of the others, you want it to be that way, but it's not that way. So people, I don't know if it's political, because I don't think it is, because this went before we got so hyper partisan. People got really mad about the Fed, and I don't pretend to know what they do, but you've got a few different options. The Fed has hundreds and hundreds of PhDs. All they do is study this stuff. So there's no way you can tell me that they're dumb. And economics now, it's not economics 101. They understand all the limitations in the models, and people are working on all of that stuff. So I think your options are, the economy is a really difficult thing, and it's possible to figure out a really small amount of signal from that noise. And if you can, then those hundreds of full-time employees might come up with that signal. Or you can say, it doesn't matter what you do, the economy is a completely random system, in which case nothing really matters, and all we're wasting is what they're getting paid. Or the final one is, you, Joe Trader, think you understand this better than they do. Like, one of those alternatives is far less likely than the other two. And that's the thing I find odd. It's like, the Fed is stupid, the Fed is corrupt, Powell's an idiot. No, Powell's not an idiot. You might disagree with what he said, but no. And he's got so much more data than you, and it's, I like watching Fed days, but I like watching it on Twitter because people just get so angry about it. And it's, I don't know, got to get your amusement where you can, right?
It is entertaining. And it's actually interesting to hear you say that, because whenever I talk about the Fed, I literally always come to that same conclusion, that sometimes I don't understand what they're doing, but I also always acknowledge that they have more information and they're smarter than I am. So sometimes connecting the gap between those is what I find interesting, to try to understand like their movement patterns a little better.
And they are trying as well. I think you've got to come at this with some sort of generosity of spirit.
Right, grace, yeah.
Like, you've got to be like, look, Powell knows what his legacy is going to be. He's not trying to blow up the economy because he's long a 50 lot of SPX puts. You know, it's like, that's not what he's trying to do. It's like, he's not a politician. He's a professional economist and a civil servant, and he will be remembered for how the economy does, you know, not whether he's got a new beach house. So I think you've got to remember that these people are trying.
Right. Yeah. Yeah. And I think it's an important point, because, and I think it just goes back to everybody's thirst for a super simple narrative that dismisses all nuance, which is, yeah, I agree with you. It is always entertaining. I also think it's always funny when the conjecture before those events is so high, and it's, to your point, I always think whatever's going to happen is going to happen. The part that I really take interest in is, yeah, like the functioning of the body and why it does what it does. Just because anytime I think about markets or the economy, it again, like I make the parallel to space, because it's just so massive and so many things are correlated in ways that you might not know. That's one of the things that got me interested in markets personally, that it's a cool way to like learn about our world around us. But so speaking of learning, you guys have your course coming up. So talk to me just about the origin of the course to get us started, and kind of give us an overview. And then I want to get into some details about it so that people can kind of learn, you know, a little bit more about what to expect. I know a lot of my audience, like I was telling you before we started, they're super stoked about it. They're very curious and they want to learn more. So yeah, what's like a high level overview to kick us off?
Okay, so this came about because people were asking me, can you teach me this? Can you teach me that? Like, can you be a full-time mentor? And the answer to that is always no, because I'm busy, I'm doing other stuff. But eventually I decided, look, I'll put this together. This is literally based on stuff I used to teach at real trading firms, right? So a couple of the biggest option market makers. Now, we're not doing the same, we're not talking about dynamic hedging and that kind of stuff, because retail people can't do it. Like, you don't have the cost structure, you don't have the technology structure. And that's an example of, if you try to play that game, you're going to lose to Susquehanna and Jane Street. That you don't want to go up against those guys in that game. So I'm going to try, or me and James are going to try and teach things that actually work, statistically valid, based on phenomena we are very confident in, and use that as the basis of trading strategies. Now, the problem with options is there's an awful lot of details you've got to learn first before you can learn why a trading strategy works or why it doesn't. And I think there are two main ways people screw up trading, right? There's the theta gang side of it, who think that there's edge lying around everywhere and it's just free money, and all you got to do is go and pick it up by selling an iron condor every week. And that's clearly wrong. And then there's the quant academic thing at the other end, where people are looking for this all-encompassing model of the market, or this perfect option pricing thing, or whatever. And that's sort of lacking in street smarts, because you got to remember, it really just comes down to, all of these things are just going up and down because other people are trading them, right? It's all driven by supply and demand. So you're looking for dislocations from fair value. And you've got to have a rough idea of what fair value is, but only a rough one. Because if you know it started here, and then there's a massive spike to up here, there's a reasonably good chance that someone's overreacted and it's driven up there by a liquidity issue That's what market making is. Market making is all these little micro squeezes. And I think this is one of the traps people fall into. They'll see a big move and they're like, oh, someone knows what they're doing. Well, what they were really doing is they put a huge order into the market and it moved the price. You know, that's the important thing, what they were doing. It's not so much they bought all these VIX calls because they think this, and this. It's like the important thing they did is they bought all these VIX calls, which bumped all the prices up. So it's based on kind of simple sort of observations like that. So I think it's professional level, but it's not teaching you exactly the same things that a professional option trader would generally do. And well, I don't mean professional like you, who make your money from doing this. I mean professional like Susquehanna or Citadel or Jane Street.
Right. Got it. So when you think about your target audience, your target demographic, who are we targeting?
You know, that would, if I was a good businessman, I would have kind of made that decision early and tailored things specifically to those people. I think it's more of a matter of me telling people what I think they need to succeed in the markets. And I think that applies to anyone. This is not in any way a cheap course, and I acknowledge it is not cheap. I do think, however, it's got enormous value. And if you compare it to the things of comparable level, there are a few MFE classes that you could do. A lot of MFE classes, their option stuff is just mathematics, right, and it's just pointless. There are a few good ones. They will typically charge you between $6,000 and $10,000 per unit. So compared to that, I think it's pretty good value. And I can't remember where the rest of my thought train was going with that.
No, it's totally cool because I have a follow-on anyways to the target. So at a high level overview, what are we expecting them to learn over the course? It sounds like there's going to be a little bit of, and I looked through the coursework, and thank you for sending it ahead of time, so I had a chance to get some familiarity, and there's like good intro to option stuff in there to help build that baseline, things about the Greeks, so on and so forth. So kind of like building a foundation, then you guys start getting into some other things. But I'd be curious to hear your summation of, before you take this course, you're starting at X point, and it seems like that point can be just about anything, maybe a general familiarity with markets and options. And then at the end, you should know this.
Yeah, in theory, you could start without knowing what a call or a put was. Mm-hmm. In reality, if you tried that, you'd get very lost very quickly, because this... Mm-hmm.
Yes.
I think you can see this with my books as well. I don't try, and a lot of times with books, people say the same thing 4 times. I don't. It's very dense. I say it once. You might have to read it 4 times.
Right.
But my stuff tends to be very dense. So there are, I think, 300 slides in this, and there's a lot of information in there. So we have to start with the mechanics of options, because we can't really talk about a lot of where the edges are coming from unless you understand that. So that's where the big problem with theta is people think theta is an edge. Right. And it absolutely isn't. And if I could get people to understand one thing about options, that would be it. But then in order to find out where there are edges, you have to know about implied volatility. You have to know about realized volatility. You have to know how they're connected. You have to know the characteristics of them. So I often say it's kind of like being a hunter, except you don't have to get up early in the morning. Actually, you do, right? Being an option trader is very much like being a hunter. But the thing you have to understand is you have to understand the characteristics of what you're trading. It's not the math that's important. A hunter isn't a biologist, but they have to know the characteristics of, this is where ducks are. If this kind of food is around, you're more likely to find a duck. If this kind of water is around, you're not going to find ducks because they're not going to be in a rapid situation or a waterfall or something. And it's like that with volatility. You kind of have to know how it all behaves. And then once you've got that foundation, then we can look at specific trades like time-based trades, like selling options overnight, selling them over the weekend, trading equity earnings, some longer dated stuff like covered calls, risk reversals, zero DTE stuff we go into. And a lot of this stuff I've talked about in my, I don't know, half an hour seminars. But the big difference here is I'm just presenting results there. Here I'm taking you through, this is the phenomenon. This is the actual way you have to make the decisions to trade that. So I tell you, vol's overpriced. Now what do you do? Which options do you sell? When do you rebalance them? What do you do if this happens? What do you do if that happens? What do you stop from blowing up? All these kind of, it takes it from a theoretical high level thing to this is exactly what you do to have to do this trade. So I think that's the big difference. Because James is completely a trader. I don't know what you'd call me. I certainly trade. And I think that experience is the big difference. So if you go to an MFE course, you're going to be taught by a math professor. It's not the same thing. And I do acknowledge this is expensive. And you get a strange pushback from people in the markets where you try to teach someone something. And they're like, well, if you've got all this money, why are you charging for the course? Which I always find odd, because no one says to a doctor, you've got all this money, why are you still charging to go to work? I mean, there was a huge amount of work that went into this, which is why we're charging for it. It's like, I wouldn't have done this if there was nothing in it for me. It's not that interesting.
Right.
But I think it's great value. So expensive, yes, but good value, I think so.
So let's talk about that real quick.
Okay,
sorry, go ahead.
No, your turn.
Well, just while we're on the cost, I figured that's definitely an interesting point for a lot of people, obviously. And it's because, at least like I was telling you before, a lot of my demographic, something around $3,000 is probably a sizable portion of some of their bankrolls.
Right.
And for a lot of the people that would be interested in this kind of course, definitely, at least from my community, like I was telling you, a lot of my community is a big fan of you because I follow a lot of your work and talk about your work with them because I think you're a great reference point for them. So one of the things that I think you were highlighting before when we were talking about the structure of the course is some of the value. And I think it would be good for people to kind of get a total idea of the cost perspective. So what is the total cost for the course?
Total cost is $2,995, because obviously there were marketing guys involved and they didn't want us to say 1,000. And for that, you get, it's meant to be 12 1.5-hour lessons, but it's going to be more than that. This thing's just grown. I think it's probably more like 14 to 16, but we're not going to rush through it just for the sake of rushing through it. Then one of the things I think is a really good selling point is we're going to have a Slack channel, and it's going to be a closed Slack channel for people who've been from this group. And it's going to be where you can ask me questions, you can DM me, and hopefully we'll get a community of people who are evidence-based options traders. And I don't really know of such a place yet around. I mean, it's certainly, like we were talking about before, if you want to talk about your opinions on the Fed and how you think XYZ politician is screwing up the world, that's great. That's for you, but we're not doing it here. This is going to be like a real, we're only here to make money trading options based on actual things, like numbers, not crazy opinions. Well, you know, they might not be crazy, but you know.
Sure.
So it's going to be very clean. It's going to be basically the only place you're going to be able to contact James and I going forward, I think. I mean, we'll still talk to people, but.
Sure. Yeah, that makes sense. So we have the upfront cost. We have kind of the main things that are included with it. A couple other questions specifically on the prelim cost, and then I want to get into some other aspects of it. So the first thing is, do you guys have like a course syllabus or something that you're going to publish so people can look through that before they choose to buy the course so that they can have an idea of what's in there?
A little bit. I can send you our sort of sales cheat sheet. which has like literally a bullet point course list.
Sure.
What people can also do though, is they can sign up, see the first class, and if they don't like it, they can just cancel at that point. So it's not so much what we teach you, it's more like the style of how we teach it. If you think that's going to work for you, that's fine. If not, that's cool. You know, you can watch the first one and then just quit. That's probably the easiest way to sort of get an idea of what's going on.
Yeah,
And I think
that makes sense.
The first one's going to be a VIX trade. So it's not going to be options at all, but it's a good sort of example for a lot of other things we're going to get to.
Right. And so that leads then to a follow-on question. So one of the things that I notice in a lot of your books is there's obviously a good deal of theory that then attempts to bridge the gap to practical application. In the course, can people expect to see like practical application of these different theories that you guys are going to be talking about, i.e., not just like back tests and these are the results of that, but like as in like this is a trade that I did at X point and this is how it went, like that kind of stuff?
Some of them, one of the problems with options is that the trades play out over much longer periods than that typically would be useful. Sure. But yeah, we certainly have some real examples in there. And we do talk people through, these are the actual decisions you will need to make if you do this trade. So a lot of the actual strategies I mentioned in my last book, you know, like the weekend effect, I think it's a paragraph. Whereas the weekend effect in this, I think it's probably going to be about an hour and a half. So that's sort of one of the big differences. But we definitely do that. We've got about, I don't know, 8 different strategies in there, and I can't promise that I do all of them at any given time, because sometimes I'm not allowed to trade certain kinds of options, or I have a mandate to do something else, or my boss tells me to do something else. But these are all things that I have traded or would trade if I could. And I don't know, about 6 of them, the effect is one of the inputs into my vol model anyway. So I guess if we want to use Taleb's phrase, there is skin in the game. We believe it to the point that we do it ourselves.
Right. Cool. Yeah. And I just wanted to elucidate that point for people, because I do think that that's a strong consideration for people that take courses like this, is to actually get the, you know, this is the real stuff, how we're actually doing it. Because and I know you've talked about this and I agree with it, like back testing and studying stuff like that is good. It gets you somewhere, but not the whole story. So I think it's cool that you guys are in it.
Options is very problematic, actually.
Right.
It's technically difficult because there's a lot of data and it's noisy data, and you've got to clean it up. And there's a lot of technical problems you can run into. The bigger problem is, though, we don't actually have that much data. Because we're not trading options, we're trading implied volatility, and it doesn't move as quickly as stocks do. It goes into regimes and stays there. So it's really dangerous you might think if you test something over the last 4 years, you've got 1,000 data points. In volatility terms, you might only have 10.
Right.
You know, and it's really difficult. It's easy to fool yourself into making an inference from that really isn't there. So we talk about that as well, and the dangers of back testing. And yeah, I can't guarantee if you do this, you'll make money, but I can guarantee if you do this stuff and don't make money, I'm not making money either. If that makes you feel like that.
Right, right. That's actually a cool phrase. Is there open enrollment? Like if somebody doesn't make the first course, can they still join for the second, third, you know, so on and so forth? And also, are they recorded if somebody misses it?
It's definitely recorded, and obviously if you watch the recordings, and we've had people from Europe ask about this, and so for Europe it's much more of a big deal because people aren't going to get up at 2 o'clock in the morning. It's all recorded, and if you need to ask questions, which you can't do live, you can do it through DMing me through the Slack. So that's true. We haven't talked about the idea of diving in and out of the course. I'm not sure that would be workable. But like I said, we do have this first free class thing.
Sure. Yeah, that makes total sense. And then another thing you mentioned earlier was the duration of the course. But then before we started recording, you were talking about kind of your thought process on the duration of like the Slack channel and the interactions. Can you talk about that real quick and just clarify that? Because I think it's an important point for people.
Yeah, I intend the Slack channel to last forever, unless Slack goes away or something genuinely unforeseen happens. I still get emails a couple of times a year asking if my old Slack channel is still around. And that company that channel was based on hasn't existed for about 6 years. So if you get a good community going like that, it has a lot of value and it really does add to things.
Right. Yeah. And I think that that's actually a big sales point for people in case they didn't know the fact that, you get the course, you get the interactions, but then there's also a sustained interaction period post, when the sessions are over, which I think is useful.
Yeah. And I'm going to keep that closed because, it's people are paid for the course. That's the access they're buying, if you like.
Yeah. Cool. And then the last question I got from some of my folks is there like a resource library, or is there any documentation they can expect to get? Obviously, you guys have the slides and you guys will have the videos recorded, but are there like any handouts, anything like that you're expecting to tie into the course?
No, we haven't thought of that. It's kind of it's a decent idea. Let me think about that. I mean, certainly for things like extra reading, we could certainly put stuff together like that. I hadn't considered that in any other way. We are going to have, I don't want to call them homework problems, but they're kind of the sort of thing, whereas if you want to do them, that's fine. So it's like at the end of a question on, say, call parity, we go through it, and it's very easy for someone to say, this is complete garbage. I don't need to know this. I'm not a professional trader. And we're going to show you why you do need to know it. And we're going to give you a question in this little homework thing for how you would then use it as an actual trader in real life and how it's actually a useful thing. And so if people want to do that, that's great. Obviously, we're not going to mark them. We're not going to, we'll give you the answers, but we're not going to there's no passing grade here.
Right. Yeah, that makes sense. And yeah, because another thing that we use, at least in I run a free Discord for people. And we have like a big resource list, and people love going through that. So if you guys have anything like that, I'm sure people would really enjoy that, like a reading list, useful websites, stuff like that.
I should put in the Slack, I should have a channel for a library channel.
Yeah, exactly. Yeah, I think people would love that. Cool. Well, that's awesome. Is there anything else that you think people should know or you want to talk about with regards to the course?
I think when I first started this, I wasn't particularly enthusiastic about the whole thing because I thought there are a million different courses out there. There are a million people who claim to teach you about options. But it's kind of got to the point where it's a bit like my books. And saying this sounds arrogant, except if you're going to write a book, that's a very arrogant thing to do to start with, right? Because you're putting yourself out there as some sort of expert. So I really think this is the best course of its kind. And I think that's partly because it's written by two traders who really genuinely trade, but also understand the theory. And we understand the problems you'll fall into. But we've just put a lot of work into it. I think if there was something better, I think we would have tried to write that. Like, I think genuinely this is as good as can be done for what we're trying to teach. And I've taught a lot of this stuff to, trading firms and things. So I kind of know what's useful and what isn't, I think.
Yeah.
I'm not claiming I can do it all the time, but I can write the slides on it.
Well, I think one of the things in what I consider with a service like this anyways is people are getting to tap into kind of your collective experience in a very condensed, focused manner, which that in and of itself is like pretty valuable in my opinion. So I'm really stoked to see the course here, how it's going and stuff like that. I think especially for the traders, this kind of thing is really valuable because, and I've talked to you about this and gave you this compliment before, but I'm happy to reiterate because I think it's cool to give people compliments that deserve them. And with your books and whatnot, you really strike a good balance between theory and practical application. And when I was looking through the slides, I saw that same thing. And I think that that's really useful for people because they get to get a distilled version of theory from somebody who's already pre-filtered. This is the important theory from this is all of the theory. And then this is how to practically apply it. So
yeah, I think we're trying to thread that needle. It's like, on one hand, you've got the YouTube guy who's like free money, free money, free money, and he doesn't even know what an option is. And at the other end, you've got the professor who thinks his option course, I mean, it's just a stochastic calculus course. You know, it's low-level grad maths. And I think we're in the middle. We're like, we're not telling you this is easy. We're actually telling you it's hard. But we're also going to tell you how to do it. And there's no magic to it. And you can learn it. And to do it, you have to learn all this other stuff. So if you're prepared to put the work in, yeah, I mean, it works. It's like Alcoholics Anonymous, right? It works if you work it.
That leads me to my
Alcoholics Anonymous, but I've heard that.
Well, no, hey, no, I'm just kidding. The last question I had for you is specifically on the courses. Like, is there any like pre-work? Is there anything that somebody that might be less familiar with options should do before they jump into your course? Because when I was looking through the slides, at least in my opinion, that would probably help them to a pretty significant degree. But again, I don't know if that's anything that you guys have thought through.
Yeah. At a minimum, you should have read Natenberg. You need that level, just the nomenclature, right? If I say delta, you shouldn't be like, whoa, what the hell's that? You might, we're going to tell you what it is, but it's going to be coming way too fast if you know nothing. So I'd say Natenberg is the absolute minimum. I would probably recommend you read my option trading book. I think it's better than Natenberg, but it's also, despite my best efforts, more advanced. So that would probably help as well. But I think if you'd gone through those two, I think you'd have no trouble following it. There's no math in it. You can't be frightened of math. Like, you can't see it and like freeze up, but you don't have to understand anything particularly deep. I think I use Taylor's theorem. I think that's the most complicated thing. And if you don't understand that, you know, you don't really need to, you can sort of jump over that as well, if you see what I mean. We can tell you the conclusions without you having to derive the equations.
Right. Well, it's awesome. Cool. Well, I know from my folks and whatnot, it's super helpful to get just an overview, right, of the course, what to expect. When people can like sign up, do you have a link that you can share with me so I can throw it in the video description and stuff like that? Or what's the easiest process to get people signed up?
We are meant to be coming up with a sign up page. It's got, we haven't done it yet. It's like, it was meant to be done Monday. Things were going very, very slowly, and then they started going very quickly. So the sign up page isn't here. When I get it, I'll send it to you and you do whatever you need to do with it. And I would encourage people, even if they're not going to sign up, right? And I understand all the reasons why they might not. Even if they're not, I think tuning into the first lesson would be, I think people will learn from that. That can't hurt, right? Hour and a half of your time.
Yeah, I think that's awesome. So I'm looking forward to it. And yeah, when I get all the links and stuff, I'll throw it in the notes below for people, and then I'll also throw it in our Discord. But Euan, as always, honestly, a pleasure to chat. Looking forward to catching up and seeing how the course is going. And yeah, we'll talk soon.
Great. Thanks very much.
Take care.